Welcome everyone. Today's topic is expert talk about raising capital, funding, and financing. So we have the pleasure to have Nancy Dakota from Chicago Funding and Rahul Vishal, CFO of Chicago RIA. So welcome, Nancy. Welcome, Rahul. Thank you for joining tonight. We're super excited to hear everything that you have to say to um, our investors. So the floor is yours. Welcome.
Thank you so much, first of all, for having us.
Yeah. Go ahead, Nancy.
So I know that everybody has been waiting weeks after weeks. It's just like what the experts have been talking about virus. 2 more weeks, 2 more weeks, 2 more, and it extended months. The biggest concern right now, where are we going to get the financing and the funding for investors, whether it's the fix and flip purchase acquisition money, whether it's the rehab money to be able to rehab properties for flips or rehab these properties for rental refinances. And again, a lot of people have been on hold for doing refis as well. So I think that one of the things that we've had a lot of conversations about was that these lenders were still organizing their guidelines. They were still waiting to see what the May default numbers were going to be, April default numbers going to be, and they just kept telling us 2 more weeks, and here we are today. Do we have programs in place? Yes, we do. Are they set in stone? No, they're not. Even though Chicago Funding has already been working aggressively with collaborating with other products out there, we want to make sure that we have a variety of funding sources for all of our investors. We also want to make sure that we also have different different opportunities, right? Because we have some people that are still very new. We have people that are seasoned. We have people that want to do these closings under their LLC or their personal name. But every program and every product is a little bit different, and it's going to be tied depending on the scenario for each individual. Do we have money in place now for purchase and rehab? Yes, we do. Are lines of credit going to be active? Can we use the lines of credit that were already approved? Yes, we can. I don't know what happened to the camera. Sorry for that. Are we able to do rental refinances? Yes, we are. But it is going to be dependent on quite a few factors. It's going to be dependent on qualifying the property for sure, on a credit score, on cash reserves, and also seasoning on title. So we can go into a little bit of specifics, but I'd like to open up the floor on how this is going to compare, or how this is changed in compared to pre-COVID and post-COVID. Do we think that lenders are going to come in very cautiously? We're seeing that. Are we still excited that they're optimistic? Absolutely, because the guidelines that we may have in place today for sure may change tomorrow, and may change next week. So Rahul, I'm going to open this up for you because I know that you're getting a lot of phone calls from investors. I know that people are still trying to figure out, is this a good time to get into the business? Is this a good time to still start investing? And the number one thing is, people all across the board, we keep hearing is opportunity is coming after a crisis or during a crisis, and we're going to expect that inventory is going to come in. So do you want to emphasize on that?
Yeah. So, Nancy, thank you for the update. But I guess the bigger thing in my mind as an investor, or in a lot of people's mind as a Chicago RIA, is uncertainty. That's the word I would say for everything. Right now, things are very uncertain. There is nothing in the which is right. You have fixed plan every day. I was talking with Nancy, every day, or actually every week, things are changing. Things are changing rapidly. They are opening up new programs. Some of the things which were open before COVID, they might not come back. Some of the things which want to take the advantage of this situation, they are coming up with very aggressive plans, and they want to capture the market. So as we are going through this very unprecedented time, from March to April, June to July, things are very fluid. Things are changing like as we go. And as an investor, I'm trying to keep track of all that information and just trying to be keeping myself safe or keeping my capital as much as capital I can retain for that situation to come. Till now, till yesterday, I guess, or till last week, none of the secondary market, where especially the Chicago funding or Nancy and they help out to people, those were not available to anybody. Like they just didn't know what to do. But I just want to take this little bit back. Like before COVID, the things were happening too fast, too early, too easy. Things were very easy for investor. A lot of the fundings, a lot of the hedge funds were funding these programs. The secondary market was open. But for an investor, I guess we'll go that in the details once Nancy has her slide, so that we can have some constructive thought on this webinar. But you have to understand your own situation, where you are. You have to find your own profile. Like, are you a W-2? Are you not a W-2? Your credit is good, your credit is not good. Those kind of things, because understanding financing is one thing, to know all the options, to know all the things you can do, but what is applies to you and what's the best route for you is the investor's job. So we can go that in more details, but I guess at this stage for all the Chicago area, for investor end of the world, I guess the big name is uncertainty. We don't know. A lot of things are just not there. Do you want to buy properties? Yes. Do not, like I bought property today, one in Hazelcrest, which was a short sale, which we put on market like maybe last summer, and it suddenly came on, it was got approved. So yes, if the deal is good, if the numbers are good, investors should buy the properties. If you have a flip, I will try to just sell it as much as possible, as early as possible, because it's still a good market. Surprisingly, we are renting a lot. This is the main time in Chicago where the June, July, August, like not June, July, May, April, May, June, July is like the busiest time where people are moving. People are changing their rentals. They're going from one apartment to other. A lot of the leases, the way I used to set up, or we used to tell all people, is try to extend your leases in this time so you can get the best lead out there. That way you can find the best deal, best lead for your rental going forward. So a lot of the leases are getting over for us. We rented maybe over 10 or 12 properties last month. June 1 was a busy day for Todd. He was basically trying to make sure all the properties are ready for the tenants to move in. So it's a mixed bag. The things are happening. There are a lot of activity on the right markets. That's coming back to that same thing. If location is good, if you're doing investments in the right area, if you're finding the right people, they have jobs, they have money, they are still moving. I know Nancy had 1 or 2 flips, and she's getting a lot of leads. I know a lot of mastery people who sold the properties in last 2 weeks. So bunch of things are happening, but still at the end of the day, it's uncertainty. Every week it's changing, and we just have to be upfront on this news, make sure that you know what's happening, and then make decisions based on that. Nancy.
Absolutely agreed, Rahul. I do think that one of the surprising factors that I think everybody was uncertain was what was going to happen with the flips. How was it going to affect the demand for housing? And it has been pretty minimal. A lot of these areas, whether it was near the city or in the suburbs, people were still buying houses. Essential workers were still buying houses. And that, I think, was a huge positive. But when it came down to the commercial lending, I think there was a lot of fear, and I think there was a lot of caution, only because they knew, how are investors going to pay these mortgages back if these properties are vacant? How are these mortgages going to be fluid on rental properties if tenants or renters were didn't have any income? So I'm glad that the housing market still stayed strong. It was probably a minimal effect in regards to the values out there. But just like you said, Rahul, we did have a couple of flips this last last 2 months, I should say. And I think that it has been positive. I'm glad that these lenders and these investors are more optimistic. Now, Do we know that these courts are going to open up right around the corner? If I'm not mistaken, in Cook County, it's going to be July 7th, if I'm not mistaken. Do we know that a lot of other inventory is coming in place? We're seeing them on auction sites today. So I'm excited that these investors are coming back optimistic. Now, just like in 2008, when everything tightened up, the moment it started becoming more and more flexible, they started coming in very cautiously, and that's what's happening now. I'm actually a little surprised on all of the feedback and the chitter chatter that we heard a couple of weeks ago. I was more concerned that they were going to be very, very strict. And now what I'm seeing is that they're deciding to be a little more flexible. 20% down is going to be the standard. If you're buying a property for rehab, whether you're going to or rental, just know that you have to come in with 20% down. As a standard, and I'm talking about across the board, is an industry. I need you to make sure that your credit is on top. I mean, minimum 660, but the moment if you don't meet the certain thresholds, you're going to be hit on the interest rate. So I'm telling you right now that if you have the 680, perfect. If you have the 700s, perfect. If you have the 720s, perfect. But it doesn't mean that it's going to be the same interest rate for the 660 borrower than it is for the 720 borrower. You're going to be, there's going to be adjustments for that. I think that as the standard industry rule right now, what we're seeing on the partners that are collaborating with their products, you're going to look anywhere between a 7 to a 10% interest rate. And I think that that's as a standard. 20% down for your purchases. Yes, they're still financing 100% of the rehab. That's a huge positive for us. And if you're able to demonstrate the investor experience, the 3 projects, 5 projects, more than 5 projects within the last 3 years, then you're considered a better risk, a better tier, and a better interest rate product itself. Rental refinances. A lot of our borrowers, go ahead.
Hold on, like you're going like from one to next to next, like people are getting confused. So no, I just wanted to, from every time you talk from a lending perspective, and you have always, because you are Chicago funding, you're talking to a lot of people from investor side of it. I guess there's little bit what is I just want to tell them, okay, what they can do right now. So who can refinance? Like, if I remember these days, like this is exactly the market of 2012, 2013, when I started investing. It was very tight. Financing was tight. What happens with financing is very tight on the back end. I'm talking about rental refinancing, because fix and flip are kind of opening up. Like Nancy said, they are starting to open up. It's available now, so you can get those financing options. But still, cash is a king. So a lot of private money lenders are still in the market. They are trying to get the best deal for their money, and obviously they don't want to keep their money idle. But they are not going to just give the money out for anybody, which was happening like before, where they were a little bit more flexible. Now they're more tight, and that's what the tight market brings for investor. Actually, it's a good market, because what happens with the investor who cannot finance, or who have a little bit less financing, or who don't know how to get all these financing, how to get the raising capital. So those people who don't have knowledge, don't have somebody like Chicago RIA, Mastery, resources like what we provide on these platforms, they are not in the market now, because they just don't know what to do. So it's actually a good investor market, that you will start finding more deals as these people will become completely out of the market, because they just can't fund. They don't have money. They just don't know what to do next. So that's the opportunity that you should be seizing right now. That if you know Nancy, if you know Chicago funding, if you know private money lending, that's where the money is there. Your money in your houses or somewhere. So right now, it's a cash is the king market. So you need to retain on your capital, and when there is a good deal, and then that's the deal you should seize right now. And a lot of people don't know how to do those kind of things, and use these resources to make sure that you're ready for it. I think Nancy is going to start taking a lot of applications on the fix and flip. So there are two type of lending. One is like we always call the front end lending. So the front end lending is there. Don't worry about line of credits right now. Line of credits are coming out. But right now, if you have a deal and if you have good numbers, you can submit your property and start getting that financing. Line of credit will be okay. That will come up maybe in few weeks. But something which is under contract, something which you want to put under contract, that can be funded, as Nancy was saying, 80-20 rule. So you have 80% purchase price, 20% is what you need to show to buy that property, but you get 100% of rehabbing cost. So those loans are still on. So I just want to take that and say, okay, this is the investors market coming, and the next 3-4 months it will be an investor market, because a lot of new investors, a lot of people who just wanted to do like the investing just on a side, they are scared, they don't know what to do, and that's where the gates are going to open for you guys. So just keep your eyes open, keep coming to these seminars. There are a lot of good seminars. Hugo and me and Andrew are putting out to Chicago RIA too. Knowledge is the king now. So if you know how to organize these deals, that's where you're going to make good investments. Nancy.
To piggyback what you just said, Rahul, and I think that it's important to share a few of the changes for the fix and flip, whether even if we're getting 100% of the rehab, just be conscious that there are minimum loan amounts that we need to be looking at. It's no longer the 50,000 as the standard that we had before. I think we should be targeting 70 to 75,000 as minimum loan amounts for the purchase price. Even though we're optimistic that we're going to continue to do the 100% of the rehab, the back end number, like we have to worry about the beginning numbers, the strategy to acquire the property, but the back end number or the back end loan, we're going to be much more conservative. These lenders are much more conservative. They're not going to be able to do these 75% cash outs that people were accustomed to. We have to be more conservative with our numbers to stay within a 60 to 65% range and still be safe, to make sure that we have enough numbers there and not get stuck with a lot of money into the property.
Yeah, makes sense.
So the rental refis, I think, is one of the bigger things. Do we see them being as lenient as before with a 90-day seasoning? Not right now. But again, what information we have available today will certainly, and I believe that will change just like it's continued to change the last couple of weeks. So right now, we're looking at a minimum 6-month seasoning. I do have a couple of lending partners still back and forth on 90 to 120 days. But those are the things that we're going to continue to navigate as we secure these other products with these partners that we're collaborating with in regards to Chicago funding. I will say that if you're going to do a cash out, or if you're just going to do a rate and term, then you have to look at anywhere between 60, 65, no more than 70%. And it's all contingent. What's your credit score? It's contingent on the back end value of the property at the time of the refi. It's contingent on, are you doing a cash out or are you just doing a rate and term? Someone just posted a question, what does a 6-month seasoning mean? It just means that when you purchase the property, that you've been on title for a minimum of 180 days, 6 months, before you're entitled to do a refi. So hopefully that's enough time for you to have acquired the property, rehab the property, rented it out. We can show the leases or we can show the rental income, and then you're able to go ahead and refinance the property on a commercial lending level. What does that mean? No W-2s, no income documentation. The property needs to qualify to be able to refinance on its own. I had another question. What does it mean of refinancing it in your LLC? Commercial lending and any of our products will allow you to refinance the property either in your personal name or either in a business name. That is absolutely 100% your choice. There are pros and cons for both. If you refinance it in your personal name, just understand that you're carrying and adding on the extra debt of that mortgage to your personal credit profile, which now you're extending your capacity of debt on your credit, and it may affect your score. So just be conscientious of that. Most investors, including myself, we prefer to do the properties in a business entity, so our personal credit isn't affected. Um, the rental refinances, just be conscientious that lenders are conservative. So we haven't seen, it's still so new to us right now, this new guideline. I don't know how is it going to affect the values of a property. I don't know if they're going to shave off the loan to value because we haven't had a whole lot of comps within the last 2 months. I don't know that yet. That really is contingent on the property you need to refi and what you're doing in that refi. Are you trying to cash some money back out, or are you just trying to pay off what you owe and do a simple rate and term refinance on that end?
Okay, so Nancy, let me take it back a little bit. So Nancy was talking particularly about the rental refi from the Chicago funding perspective. So Chicago funding does only commercial side of the uh, refinancing. So somebody who cannot do the W-2, cannot do uh, uh, the credit is not good, they are the ones who can get into this program, because what she said, the property has to qualify. It's not your qualification. Your qualification is only credit. You have to keep it as healthy as possible. But as long as you're above 660 or 680, means as you go up, you're going to get better terms. You're going to get
Yes.
better rates, and obviously you'll get better LTVs as we go forward. But from an investor perspective, like I said, I'm trying to go back. There are multiple ways of doing financing, multiple ways of doing funding. You need to understand what is your profile, what you are. So, like Nancy said, you can do it in both your LLC and your personal name. Whenever it comes to commercial, if you know that you are not going to qualify for the traditional residential financing, generally the big banks like the Chase, the Homebridges, those kind of people who do the 30-year residential loan, if you are not going to qualify for that, I would just keep property directly into my LLC. Why you want to keep it in your name? So you have to understand who you are, and the way this goes is like, for an investor, you're trying to get the best buck, or you're trying to invest in your property with less capital cost or less cost to you. So the way financing goes is, the best rate right now you're going to get is on a residential 30-year mortgage. They are anywhere, even for investment property. So you can do almost 10 properties in your name, including your personal residence. But for that, you have a very strict guideline or strict qualification requirements, and not everybody can qualify for that. The only people who can qualify for that is who somebody has a W-2 job, and somebody who has some money to show for the reserves, and somebody who has done 2 years of taxes with their liability ratios are right. So it's a very strict guideline. But a lot of people, when we talk in mastery, is busy professionals. All those people get into that category where they have a good job, they have a good W-2, and they have investment property. They get qualified for that. For them, just eyes closed right now, that's the best way to go. First 9 loans, you have to put that straight into your name and get to the companies like Homebridge and those kind of a 30-year residential mortgage, and you can get financing on that. The next stage, if you can't do that, or if you have too many, like you come into my category, where once you finish your quota of 9 properties, residential loan, now you cannot do the residential loan anymore, because there is a federal guideline of only 10 loans per person. So now what I'm doing right now is I'm going back to my strategy of talking with community banks. That's the next stage. These are the small banks who do the commercial loan, but these commercial loans are 5-year term, 5-year balloon loan basically, but they are amortized at 20 to 25 years. So these are the note which get mature at 5 years, but the rates are excellent right now. Rates are maybe into 5 to 5.5%, where your 30-year mortgages are into 4.5 to 5%. Where the next stage is your community banks, where they are a little bit open, but they still have similar guidelines like the residential, but they are a little bit, it's a relation-based model. So as long as you have good credit, you have some business where you're showing some income last 2 years, not necessarily W-2 income, but your 1099 or your K-1 income coming from your business, that qualifies for those kind of loans. So that will be your second choice. So as you go from residential, the next stage is basically the community bank. And the third stage, which is covered when Nancy comes into picture, is the Chicago funding. So you have to understand where you are as an investor. That's the main key goal, is to find out your own profile, what you can do and where you can go, so there is a less money, for like less cost to you to get these loans. Those two loans, like basically the residential and the small banks, they were still lending. They are still on. There's no changes. The only problem there is they are too busy with this federal SBA loan right now that everybody is okay. They're so swamped with all these applications coming on the small bank loans that they are not accepting any applications. At least for last month, they started doing a lot of loans now, but that will be your second stage. But obviously, the third stage is coming to Nancy, because that's where you can actually get the loans on your property. And if you're doing like multiple projects, it's always good strategy. That's what I use too. What I do is some of the loans I go for residential, some of the loans I go for the banks. But when I need to get the project done fast and loan has to be go through fast, I go to Chicago funding to get my loan done. So when you, depends on what kind of investor you are. If you're doing a one deal at a time or you're doing a 3 deals at a time, where is your credit score? Is the credit score is low or high? Do you have W-2 or do you don't have W-2? So you need to sit down and come up with that profile for yourself. And as you graduate from one profile to the next one, your goal as an investor should be getting to that 30-year residential if you can. If you're somebody who buys like 3-4 properties like me, you can just keep with Chicago funding because it's easy. Sometimes it's just I want my money back because I want to buy next 2-3 properties which is coming, and I don't want to lose those, because the residential takes longer time. The smaller banks also takes longer time. So I want my money back so I can start buying more properties. So it depends on what your goals are and depends on what your profile is. But that's how I would look at financing and raising capital for the investing.
I'm glad you talked about the different parameters, and especially on the interest rates. When if it's a full doc loan, yeah, you're looking at the 4.5 for sure. When you're looking at the commercial lending, right now they're telling us that starting interest rates on the rental refis are going to be about 6.5%. However, contingent on the credit score, contingent on the loan to value, even contingent on the amount of cash reserves, we're going to have that conversation one by one. Every case is different, and every refinance or every property needs to be qualified independently. So I do think that it's still very optimistic. And I continue to say this, the information that we have today, I hope that will continue as we move along, and lenders are going to be a little more comfortable with opening up a lot of more flexibility in that. Our loan to values and our rates are going to be better down the line. But right now, conservatively, everyone just needs to be prepared. Make sure you have your cash reserves in place. Please, 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 guys. Even for your purchase money or even for the rental refis, liquidity is key. Just like Rahul said, cash is king. Just make sure that your credit is there. Please make sure that you do what you need to do, that the guarantor for these loans at least have the 660, if not the 680 credit score. The better the score, the better the tier, the better the rate for sure.
Nancy, there's a question about like just taking one example. You want to just take that for a fix and flip, like 100K purchase, 20K rehab. What is the loan expected? What is the loan they can get with the current parameters you have, fix and flip?
So absolutely. So right now what we're looking at, if you're looking at 100% purchase, $100,000 in your purchase, you are looking at 20% down, $20,000 as a down payment. If you're financing $80,000 and it needs another $30,000 in rehab, then yes, for sure, you're looking at your loan amount to be about $110,000. Just understand that at the back end, hoping that after the refi is done and you're able to do the rental, whether it's a few months down the line, just understand that both of those loans, both your purchase money and your rehab money, is still within 60 to 65% of the new ARV. Numbers is everything. People were very comfortable at keeping it at the 70%. But because we are in a different time frame right now when it comes to lending, I'm going to say be more comfortable and be more conservative, that at 65%, that should be your targeted number, no longer 70, until guidelines change.
Yeah, so
Go ahead.
No, I just wanted to make the numbers clear. We don't have board, we don't have something to write down, but I'll just make it easy. So if you 100K purchase, what Nancy is saying that they will give you $80,000 loan at the purchase time. Then you have, let's say, $25,000 rehab on it. So they will finance the entire 25, but that's not coming like 25 on the first day. They might give it like 1 or 2 draws as you get into the rehab. The total loan, like she said, 80,000 plus 25. So that becomes $105,000 of total loan, and you put 20,000 from your pocket at a purchase. So that's your total 125 of your project. That's how you can finance that. Now, if it's a flip, then obviously you're just going to put it on market, and let's say your ARV is 180. That's what Faisal is saying on this question. You should be able to make some money out of that. If it's a rental, like Nancy was saying, if it's a rental and your ARV is 180, now the front end you'll still get that 105 loan with 20,000 of your own money, because it is still within the guidelines of that ARV. So $180,000 ARV, 75% of that is still less or still more than 125 which you're borrowing from that loan. So you're good on the front end. You're good on the fix and flip part of the loan. Now, when it comes down to rental loan, now it's a different story. Now, as of today, the only guidelines we have is like we are trying to keep it LTV of 65%. That's just keeping it conservative. It will go to 75 hopefully soon, which was before COVID situation. But let's say it doesn't go. So for your practical or keeping conservative numbers, let's say 65. So I don't know, $180,000 ARV. 65% of that is I wish I have. Okay, hold on. Just to make it sure. So that's 117,000. So if you are trying to refinance this property for a rental refi on a back end with an ARV of 180, with today's guideline, you're going to get a loan of $117,000. Now your front end loan was 105 plus 20,000 of your own money, and your back end loan is 117. So you're going to leave some money in the property because of the current guideline of 65% of loan to value ratio. In normal days, if it's a 75% LTV, then you can get a loan of $120,000, and most of your money will come out of the project. So you just have to, and I did this on the fly. I know there's a lot of numbers and people get confused when I start talking numbers, and that's the thing I like. So, but anyways, I don't want to confuse you guys more. Faisal asked that question, so I just wanted to make sure that I'm trying to use the full numbers. But as of now, back-end numbers are 65%. So be conservative, keep that number conservative for your private money lenders or for your anybody who is giving you money, and try to get the deals in that 65% of the ARV, and then you'll be good. And so you want to run through your presentation, or we covered most of the stuff?
We covered most of the stuff. I don't have a PowerPoint presentation in place yet because we're still getting some guidelines and matrices from a couple of other lenders that are collaborating their loan products with Chicago Funding. I will say that it is interesting to know one of these lenders, and I don't know if it has to do with the courts, one of these lenders is able to provide up to the 75% ARV. They're out of state, but it was interesting to find out that the exception to that rule, if the property was in Cook County, they would shave off 5% of that. I thought that was interesting because that might have something to do with the courts. I don't know. What do you think about that, Rahul?
No, and that's the thing. I heard that not just the Cook County, but in general Illinois. Like one of the lenders, I was talking with them, and they said, okay, we just don't want to touch anything in the Chicago or Illinois market because of the court system, because of the laws we have, and maybe the courts are closed right now, and they're closed until like 7th of July. I think the foreclosures or the sheriff is not opening until 17th of and most other counties, same thing. So they are looking at Illinois as different. They opened up a lot of things in Florida and in Texas and other states, but they are a little bit more conservative, more cautious. They're playing a little bit safe in Illinois, and especially in the Cook County, just because of the court system here. There was a question about the ARVs. Yeah, technically, like what we in Mastery, we try to do a 10% less ARV for rentals, and I'm talking specifically for rentals. And this is because the way me and Andrew look at numbers is we want to keep numbers very conservative. So if 180 is your flip ARV, we try to use 10% less ARV for rental. Will that change? I haven't seen any market impact yet on the ARVs because of COVID. So it's not like properties are appraising less than what it's supposed to be because it's a COVID environment. So I don't see that effect yet. But guys, what happens is like ARVs are based on 6 months back. So right now, when appraisers are going out there and they're appraising the property, they are looking at the closings in March, April, which were already in place in February or maybe in January, because the closing takes place 45 days anyways from the closing or the flip closings, which are the main comparables for your properties. So market was still strong back in like February, March, even in April, even today also. So it's not like properties are not selling, or what the only problem happens in the smaller pockets is, and that happened in one of the areas where people started dumping properties for no reason, and that started creating a calm for appraisal. And now the market suddenly goes down in that particular pocket. So it's very important for you to see when you're buying a property, just make sure that certain type of condition is not created in that community, that somebody just start dumping properties because they want to get the money out, or they just want to get out of the market. I haven't seen that in the markets which we have we are doing business. So the impact of COVID on ARVs is still not there, and which is very surprising. And like I said, the market is still strong. People are actually selling property who are there for the flips. So somebody who had the properties they're working on through March and April, they could be able to sell in May and June. And that's a good thing for all of us, because now the market price is still there. So they are still hitting the ARVs which they were expecting before the project started. Now they can get the ARV for going forward next 3 or 4 months. So, but I would still try to keep it very conservative, just because that uncertainty in the market. People just have lost the interest. They have lost the security. They just don't know where things are going, and people are just still on the sideline. But same thing, I was talking with Nancy, that once the floodgates are going to open, like let's say everything starts opening up, then there'll be a lot of applications coming to Chicago funding, and Nancy will be very busy. So if you have something going on, I would start getting all the documentation ready. I'll start getting all the things ready, your reserves. How to make sure you have some reserves in there. Work on your credit to get the credit as up as possible, as high as possible. And then that will help you to get the refinancing done quickly and at the better rates than what you expect right now. And somehow Nancy's gone, and I'm the only one who's talking here. Nancy, you there?
I'm here.
Oh, okay.
I was actually trying to look at the conversation because I know people were having questions, but as soon as it's coming up from my screen, I was trying to find it so we're able to address it. I'm glad you said that, Rahul, because the reality is that even though we know that the lenders are going to be more conservative, but they're also very optimistic. Do we think that right now more inventory is coming into the table? Absolutely. I'm seeing it on the auction sites as it is, on how things are starting to open up for investors. But I am also very hopeful that people are putting their ducks in the row, that the cash reserves are there, that their credit score is going to be there, and not to get discouraged. We still have programs for the new investors, for the ones that haven't had 1, 2, or 5 projects. I just need them to know that their interest rates are going to be a little higher because the risk is a little higher. But at the end of the day, it starts with anything. It's just like you, Rahul. It's just like me. We all started from zero. We all started with the challenging of finding the funding for the first one, and then how to recycle it out and going for the next one. And at this point, it could come to a point where you're doing 2 of them or 3 of them at the same time. But conservative, conservative, conservative. Make sure you have your cash, make sure you have your credit, and make sure you're conservative on your numbers. And I think that you become, everyone becomes winners in this game.
Yeah, I mean, like you just said it, like the financing is I guess the real estate investing is financing. Like I always joke with everyone, like when I started doing the first few deals, I was dealing in thousands or 10,000s, and I was getting sweat out of it, like how I'm going to get the next one and how I'm going to get the financing for the next one. Now the situation has changed. I'm still cash poor because I'm just financing now maybe 10 deals at a time. So the numbers have gone from 10,000 to maybe 100,000 to $1 million. The problems are still same. We're still dealing with the financing issues, but it's at a different scale. That's about it. And it never stops. It only will stop when I stop buying properties. And obviously, we are not going to do that. So if you can find a way, or you can understand financing for yourself, and I keep repeating that, financing for somebody else is a different story. If Nancy can finance a property, not necessarily that same property I can finance, because she has a different situation, different things into it versus what I can bring to a table, or somebody else can bring to a table. So you need to understand what is it for you, and that keeps changing every 6 months, every 1 year. Your profile is going to change, because as you get more properties, or as you get a job, or as you get your credit score high, you need to keep changing your strategy, how you're raising the capital, how you're funding it. Your job as an investor is to reduce that capital cost. That way you can put more into your project, buy more properties, and that way increase your profile or increase your portfolio. So it's the same game I was playing back in 2012 when I bought my first property versus I'm buying my 100th property or something right now. It's the same game. The game hasn't changed. The only thing is I just know a few more tactics. I just know a few more things, so I can tweak the game a little bit and get more points out of it. That's about it. So you need to get into the game and find your skill set, get more skill set, and get more financing for your investing.
Guys, there's only been such minimal changes, but I still need you to know that loan amounts, there are minimum required loan amounts like we discussed earlier. Your cash reserves are going to be minimum requires for sure. Seasoning on title, there's a minimum requirement too. Just reach out. All I'm saying is reach out. We got to qualify the property. We got to qualify your assets, and take you to be able to get the lending that you're looking for. If you do have a contract, just reach out. Send me an email, send me a text. Let's sit down and how I can navigate on the different opportunities and products that are out there. What best works for you at this time? Because even though one program is really great for you today, it may be a different program a few months from now, because now you have another level of experience, just like Rahul said.
I guess I don't have anything else to share unless we can get more questions. But if Hugo is on the line, Hugo, you want to add anything else? Or
I think Hugo abandoned us.
Yeah, I can see him active. But anyway, I looked at all the questions here. I don't see anything new coming up.
Okay.
Hey, I can see Hugo. There you go. Hugo, can't hear you. You're mute.
Nope, Hugo's
Nope.
gone. Please.
I can see his screen.
Can you
He's
hear me?
talking. Now
Yes.
I can hear you.
Can you hear me? Oh,
Yeah.
okay, perfect. Microphone. No, absolutely. I mean, just to quickly summarize everything that Nancy and Rahul said, friends, liquidity is going to be critical, and keeping your credit, it's going to be super important to get better rates. And then at the same time, the question is, should you be buying properties? Absolutely. You find the right deal where the numbers make sense, where you have equity, you have cash flow, and the debt coverage ratio is over 1.2, then for sure it's a great way to start building your rental empire. And then at the same time, right now you have to be very conservative on the flips. Until things completely open, flips are very risky. Um, so that summarizes in a nutshell about funding, right? The fact that we have to focus on asset-based lenders where they're going to be focusing on the property itself, not so much uh, on your profile as individual. So those are the key points to take away. And then continue. So the three keys for you to getting off to a fast start is number one, start looking to find great off-market deals. If you don't have access to Chicago DealVault, we're going to give it to you for free for the next 30 days. Second point is start reaching out to Nancy Villacorta to get a line of credit, to get the roll bowling on the financing. And number three, start talking to sellers, listing agents, and start making offers, because that's when you're going to be making money in real estate, when you engage in those three activities: talking to sellers, talking to listing agents, and start making offers. So that's in a nutshell a quick summary. And I want to thank Nancy and Rahul for taking time out of their busy schedule to join us tonight. The information was incredible. Nancy, Rahul, thank you very much.
Thanks, Hugo, for the chance.
Thank you.
Friends, are there any other questions on the line while we have Rahul and Nancy with us?
There's a comment there like, what is the cash is the king. My point there, cash is the king, is like, if you can raise the cash, doesn't make a difference. It's your cash, it's a private money, it's any other cash or institutional money. As long as you can raise the cash, the deals are coming up. So who can play that game better, they'll be successful finding more deals, because if you can have cash ready, reserves ready, you'll get a better chance of getting that contract accepted. So it's becoming like that kind of a market where the financing is a little bit strict, which is good for investor. Like I'm saying, that who can raise the capital right now, those are the guys who are going to compete more, and the people who don't understand financing, they are going to fall behind on the investing.
It's just
Great.
like anything, Rahul. When we face some kind of uncertainties or challenges, it's going to weed out the ones that weren't serious about the business, and it's going to open up the opportunity for the ones that are serious about the business.
Yeah, agree, totally agree. Thanks, Hugo.
Perfect. Thank you very much, Rahul. Thank you very much, Nancy. I appreciate your time tonight.
All right, have a good day.
Thank you. Okay. Bye-bye, Rahul. Bye, Nancy. Thank you. So friends, for those of you who still don't have access to Chicago DealVault, we're going to give it to you for free for the next 30 days. In Chicago DealVault, you're going to be able to find those off-market properties. And not only that, but we also have access to over 6,000 private money lenders. Okay. So if you're interested in getting DealVault for the next 30 days, just fill out the form that I'm going to send out via the chat. And then as a friendly reminder, please RSVP for our next bootcamp is going to be at the end of the month. So it's going to be on June 28th, it's a Sunday from 1 to 4. It's going to be an incredible event. We're so much looking forward to that. So I'm going to send you the link so you can RSVP. And then we're going to send the replay for today's event tomorrow morning. Okay, so, and then what's really cool is that we're going to do the bootcamp this time both in Spanish and in English. So this is, I'm going to send this via the chat. So right here, make sure that you RSVP for the bootcamp. That's the English version. And then in the morning, we are going to do the Spanish version. Okay, so Spanish, it's right here. Okay, now if you need to have access to Chicago Deal Vault, all you need to do is fill out this form. Free 30 days. Fill out that form and then select the package special. So the package should be special Chicago Deal Vault, and then the promo code is funding. Okay, and then you should get it for free for 30 days. We're gonna train you one-on-one. We're gonna give you unlimited access to private money lenders. So right here, what they were talking about, raising capital. So we're gonna give you access to private money lenders over 6,000 right here. As you can see, we have 6,600 private money lenders, individuals who chose to be passive investors, and they lend their money to investors like you and me in exchange for a return. So you'll have access to private money lenders and also to reach out to hard money lenders, asset-based. We have them right here. So all you need to do is go under Chicago Deal Vault, and this is how you will also reach out to Nancy. So right here, hard money lenders, right here. So these are our preferred hard money lenders. Are there any other questions? Are there any other questions on the line? So I just want to make sure that you have all the resources. I want to make sure that you have all the resources available for you. So make sure that you reach out to Nancy, and also that you start raising capital for your 2020 deals, reaching out to private money lenders, because remember, these are relationship based. It's who you know, so the sooner you start building relationships, the better off you're going to be. Are there any other questions that I can help you answer? Okay, no problem. So yeah, please make sure that you RSVP to the bootcamp, either the Spanish or the English version, and then get DealVault. If you don't have access to it, make sure that you sign up. We're gonna give it to you for free for the next 30 days, train you one-on-one, make sure that you have access to all the resources, including 6,600 private money lenders and hard money lenders, okay, institutions like Nancy, who can help you get a line of credit. So when you're ready to make an offer, pull the trigger, boom, you have your line of credit ready. So thank you everyone for joining today. We are going to send you the replay tomorrow. Hope it was very informative, and I look forward to seeing you tomorrow. Okay, so how do you sign up for the training with DealVault? Very simple. You see this green icon, green, it says schedule training. So I'm gonna send you this form. So you can pick a day and time, and we can schedule the training one-on-one. Okay, are there any other questions that I can help you answer? So please make sure that you schedule your training. Once you have access to the system, it's going to be one-on-one. And in fact, you have unlimited training sessions one-on-one. So we want to make sure that you are fully trained, not only on the system, but everything that has to do with real estate. Okay, So thank you everyone for joining. I look forward to seeing you tomorrow. Okay, thank you everyone. I'm gonna stay on the line for the next 2 minutes just to answer any questions that you may have. Okay, so another question, if I sign up for training, this includes additional information? Absolutely. So we're gonna pretty much train you on how to identify hot flipping markets, rental markets, how to access great off-market deals, how to analyze them in seconds, how to wholesale, how to do the fix and flip, and finally, how we're going to give you the secret sauce to build the rental empire. So we're going to show you the secrets of how you can recycle money. So you have very little money down on the deal. So that's how you're going to grow exponentially. So we're going to train you one-on-one. May require multiple sessions, but we have a vast number of resources available to you. So yeah, our contact information, it's so you can reach us at support ChicagoDealVault.com. Okay, that's how you can reach us. So yeah, please make sure that you sign up, Brittany. And that's our email address. Any questions? But yeah, it's going to be unlimited training. Okay, we want to make sure that there's nothing on the way for your success. Okay, we want to make sure that you're successful today. That is why we're running 2 up to 4 webinars a week. Not only that, we're putting together a very comprehensive bootcamp over the next 3 weeks at the end of the month. So we're going to cover everything from wholesaling, fix and flip, and rentals. So it's going to be a super amazing event. Make sure that you RSVP. Brittany, yeah, please make sure that you sign up. So again, the way to sign up is go to this form. Okay, the package should be special Chicago Deal Vault, and the promo code should be funding. Okay, you're gonna get it for free for 30 days. Oh, the training is free, by the way. So unlimited training, it's absolutely free, one-on-one. Okay, it's part of the membership. Yeah, when you are a Deal Vault member, we want to make sure that we give you all the resources, all the training, all the technology, access to the right information at the right time, so you're successful today, not tomorrow, not in 2-3 months. We want to make sure that you're successful today.